Hoji John AG, back with you again. We just witnessed another absolutely wild overnight price massacre that left a lot of people shaken. Silver crashed down to a low of $71 per ounce, completely flushing out positions left and right. Gold got hammered all the way down to 43.99 before it started to recover, and then we saw this massive bounce that honestly caught everyone off guard. Right now, as I'm recording this pre-market session, silver has clawed its way back from those 71 lows all the way up to 83. That's a 17% recovery bounce from the absolute bottom, which is pretty incredible to witness in real time. Gold managed to recover about 250 points of that brutal $450 loss it took. From the intraday lows we just saw, gold is sitting up 7%, while silver has gained a solid 15%. Pretty impressive numbers, but the volatility we're seeing is absolutely insane, and everyone's just waiting with bated breath for that New York session to crack open. In my previous videos, I laid out very specific scenarios for silver, and I was using Bitcoin as our primary leading indicator for a very clear reason. When you get these large-scale shifts in risk sentiment hitting the markets hard, crypto, and especially Bitcoin, tends to move first, giving us this critical early warning signal for commodities like silver. My directive was crystal clear: watch whether Bitcoin closed the weekend above or below that 82,000 level. I specifically said that if it closed below the 80 to 82,000 range, you should expect that selling pressure to spread like wildfire across other assets. Well, it closed at 76,000. The absolute lowest it hit was 74,500. I specifically warned everyone that if Bitcoin tested 74,000 or went below that level, it would confirm significant weakness across the board. Go back and watch that prior video if you want. I'm not making any of this up after the fact. This was the absolute cornerstone of my bearish thesis going into this week. And what exactly happened? We got hit with that precise spillover selling that I predicted would come. Silver took a beating, dropping hard to that $71 level. Then we witnessed this relief bounce, a massive 17% move back up to 83 in silver. Now we're all sitting here waiting for New York to open so we can see whether this bounce has any real staying power, or if we're just setting up for the bearish scenario to resume with even more force. I made sure to read through every single comment from yesterday's video. Thank you for that engagement. It's genuinely powerful to see you folks using this information to make sharper, more confident decisions in these volatile markets. The split in perspectives among the community was crystal clear to see. Some of you are actively preparing for another major leg down, while others remain firmly anchored to that long-term macro thesis. That division doesn't signal confusion in the community at all. What it shows is a group of prepared individuals, each one executing their own carefully thought-out plan. That's exactly the core of what we do here. Independent thinking, not herd mentality following the crowd. We don't sell fear, we don't sell greed, and we certainly don't sell that Netflix-style hype about instant riches that seems to dominate financial media these days. This isn't some scripted show with a predetermined happy ending that makes everyone feel good. These are real markets with real risk and real consequences for getting it wrong. Now, here's a critical reminder for everyone watching, especially those who might be new to this channel. I absolutely do not sell signals, courses, mentorship programs, or any kind of paid service whatsoever. Anyone claiming otherwise is running a scam. Block them immediately without hesitation. My only role here is to provide a clear, unfiltered view of what's actually happening in these markets. I operate exclusively on X and YouTube under the handle OG John AG on both platforms. That is the one and only legitimate source for my analysis. I'm not associated with any other accounts, websites, or services. Protect yourselves out there. I will never, under any circumstances, ask you for money. Now let me walk you through the current data as I'm recording this during the pre-market session. Shanghai spot silver is sitting at $11.99. SHF futures are at $1,142. Western spot is at $83.47. Western futures are also trading at that same $83.47 level. The premium right now is $18.52. That works out to a 22.19% premium, which has actually come down significantly from that insane 43% premium we were seeing over the weekend. But we're still looking at a 22 to 23% premium right here in pre-market. Absolutely crazy volatility while everyone waits for New York to open and show us what direction we're really heading. Here's exactly what happened overnight and this morning that has everyone's attention. We just witnessed $10 trillion wiped out in just 3 trading days. Gold is down a staggering 20% from its recent peak, which has erased $7.4 trillion in total market value. Just to put that in perspective, that's 5 times the entire market capitalization of Bitcoin. Silver crashed nearly 40% from its highs, wiping out $2.7 trillion in value, which equals the entire cryptocurrency market cap. Safe haven assets are moving like crypto meme coins right now. This is that Kevin Walsh Federal Reserve Chair sell-off that just keeps continuing to hammer everything. But here's what makes this situation fundamentally different from a normal market crash. Central banks around the world did not start selling their gold reserves. Tether didn't liquidate its gold holdings. The United States government has not magically found some plan to reduce the national debt significantly. In fact, the US government literally shut down because it can't get its spending issues properly resolved. So the question everyone should be asking is, why exactly is gold puking so hard when none of the fundamental drivers have actually changed? There seems to be a serious disconnect between the different markets that trade gold around the world. But the second major reason is that someone desperately needs liquidity and is selling gold assets to get it, which means we're seeing a lot of paper shuffling going on because absolutely nothing in the fundamental backdrop has changed since Thursday, other than maybe the banking system hitting some kind of major bump in the road. The way gold is selling off while equity futures and Bitcoin are falling, yields are dropping, and the dollar is starting to show some strength. This isn't normal price action at all. This is pure stress selling. When gold gets sold like this, it usually means something significant is about to break somewhere in the system. What we're looking at is a genuine liquidity crisis unfolding. In a true margin call event, funds don't get to sell what they want to sell. They have to sell what they can actually sell quickly. Gold and silver happen to be liquid, profitable positions for many institutional players, making them the first piggy bank that gets smashed when the margin clerks come calling with demands for more collateral. Now here's the smoking gun evidence that proves this is pure paper manipulation rather than any kind of physical fundamentals breakdown. People are literally queuing up to buy gold in Singapore and Australia, not silver because that's been broadly sold out for weeks. In Hong Kong and China, there are no queues being reported simply because premiums are so wide and physical supply is becoming genuinely scarce. Silver is broadly sold out in those markets too. In Europe, precious metals dealers have actually pulled their silver offers entirely. People were still lining up to buy gold in Singapore even as prices were plummeting in real time, showing this extraordinary resilience in retail demand for precious metals that completely contradicts what we're seeing in the paper markets. Looking at the subscription numbers, about 75% of the people watching this content aren't subscribed to the channel yet. If this unfiltered, real-time analysis is cutting through the noise and helping you make better decisions, please hit that subscribe button. If you're finding value in this content, drop OG John AG in the comments section. I'm here specifically for those who want clarity and substance, not polished hype that tells you what you want to hear. The reserve in Singapore, which happens to be one of the world's largest private silver storage vaults, says that physical silver demand actually increased during last week's crash. The reserve is seeing a growing divergence between paper and physical markets and expects physical shortages to get significantly worse from here. Meanwhile, if you check the current price of silver on China's largest e-commerce platform, JD.com, it's sitting at $163.35 per ounce today. COMEX is trading at 83. That represents a 95% premium over the paper price. Let that number really sink in for a moment. JD.com is at 163, COMEX is at 83. That's a 95% premium for physical delivery, and silver is still trading in backwardation, which means the physical market is screaming shortage. You simply cannot cure a massive physical shortage by manipulating the paper price lower. This manipulation has absolutely nothing to do with actual physical supply and demand dynamics. It's being done to prevent a Western financial crisis due to policy choices made by those currently in power. It's becoming incredibly obvious to anyone paying attention. Whatever is happening behind closed doors in the financial system must be truly massive in scope. Silver remaining in backwardation means there's a genuine shortage of physical metal, and all these short sellers are going to have to make actual physical delivery at some point. They're playing an extremely dangerous game this time around. We're currently in the middle of a precious metals revaluation process where COMEX and LBMA are being systematically drained of physical gold, but especially physical silver. All the short sellers care about right now is keeping paper prices artificially low while they try to cover their paper short positions and minimize their losses before this whole thing blows up. At the end of this revaluation process, the full price discovery will finally unfold, and especially silver will be trading at much higher levels, reaching a gold to silver ratio of at least 15-to-1 from current levels. What's particularly striking is how the net volumes on silver futures at COMEX continue to tell a completely different story from what the price action suggests. Yes, they tried to crash the price relentlessly all last week until they finally succeeded in triggering major selling. but the overall trading volumes are still almost balanced outside of those large, heavy dump orders. This means the price is being driven lower through a combination of spoofing during overnight hours and wash trading during U.S. market hours. Because the price was being artificially forced lower, it triggered massive derivatives unwinding in large ETFs like SLV, but especially AGQ, which created that flush through all the stop-loss orders. It goes without saying that this has absolutely nothing to do with the actual physical market, where the fundamentals remain completely unchanged and the physical shortage continues to worsen by the day. SHFE silver vaults remain stable. The Shanghai gold parabola is still intact, but it definitely needs to bounce from these levels. SHF silver futures hit the daily limit down of 17%, causing the contract to lock at the lower price limit with heavy one-sided selling and very limited or effectively no two-way trading for the remainder of that session. That tells you the Chinese market is under serious stress, too. But the physical vaults remain stable. The premium is holding firm. Physical silver isn't breaking down, only the paper contracts are breaking. Now let's talk about what the New York market open could potentially bring us. I see two distinct scenarios playing out. Let me give you the bearish case first. If New York opens and that selling pressure continues with the same intensity, we could easily see silver test that 71 level again, or even go significantly lower. The 17% bounce from 71 back up to 83 could turn out to be nothing more than a relief rally before we see even more downside pressure. CME margin requirement hikes took effect today, which means if traders can't post the additional capital requirements, we're going to see more forced liquidation across the board. Bitcoin, sitting at 70,4,500, has already confirmed the exact weakness that I predicted would spread to other risk assets. If Bitcoin breaks lower from here, that's going to spread risk-off sentiment to absolutely everything. Here's a staggering number. $9.6 trillion of U.S. marketable government debt will mature over the next 12 months. That's the most in history. This represents double the amount we saw before the 2020 crisis. This accounts for 33% of all outstanding government debt, which is one of the highest percentages we've ever seen in history. Most of this massive debt load must be refinanced at significantly higher interest rates than when it was originally issued. The U.S. debt crisis is genuinely hitting a completely new level of severity. This creates systemic stress throughout the financial system that could easily trigger more selling across all asset classes. We're literally watching the everything bubble pop in real time right before our eyes. The S&P 500 is currently trading at its most expensive valuation multiples in recorded history, higher than 1929, higher than 2000. A mean reversion from these levels would be absolutely terrifying, but it's also completely expected based on historical patterns. History clearly tells us that during deflationary crashes like we saw in 2008 or March 2020, precious metals initially get dragged down alongside equities. When the selling in metals finally stops but equities continue falling, that's typically when you know the bottom is in for metals. Until we reach that point, the deleveraging process is going to be absolutely brutal. That's the bearish scenario for the New York Open. But here's the bullish case that could also play out. The bounce from 71 up to 83 is actually holding pretty well in pre-market trading. If New York opens and this bounce continues to build momentum, we could potentially see silver regain that 87 level, maybe even test 90 by the end of today's session. Sharp drops like we just witnessed are specifically designed to trigger maximum fear and panic. That's exactly how markets systematically shake out impatient money from weak hands. Gold and silver just experienced a significant pullback, but the underlying macro backdrop that's been driving this bull market hasn't fundamentally changed. Debt levels, deficits, geopolitical tensions, monetary policy uncertainty. All of these major drivers are still very much in play. Corrections are completely normal and actually healthy for long-term bull markets. Extreme volatility does not automatically equal trend reversal. Silver is nowhere near forming a top or entering bubble territory. It remains severely undervalued relative to stock market valuations. The current gold to silver price ratio is sitting at 57 to 1. The historical average ratio is 15 to 1. The COMEX vault ratio is 1 to 12. The mining ratio is 1 to 8. The LBMA vault ratio is 1 to 3. Available above ground supply ratio is 1 to 1. These fundamentals are going to take control of the pricing mechanism sooner rather than later. When that transition finally happens, silver is going to absolutely explode higher to catch up to these historical ratios. People need to understand a critical point about Western gold and silver markets. There are far more paper metal contracts outstanding than there is actual real metal available for delivery. This current sell-off is massive paper dumping, specifically designed to fool the general public into avoiding precious metals precisely when the stock market is about to collapse. Look at how unstable and manipulated gold price action has become. But physical buyers around the world know much better than to fall for this manipulation. Singapore has queues of buyers, Australia has queues of buyers, China and Hong Kong are completely sold out with extremely wide premiums. JD.com is showing a 95% premium over paper prices. This is physical demand systematically overwhelming paper manipulation in slow motion, and it's only going to get more pronounced from here. Bank of America's bull and bear sentiment indicator is currently registering one of the most bullish readings in its entire history. From a contrarian perspective, extreme bearish sentiment very often marks major bottoms rather than signaling more downside. For those who recognized value in silver when it was trading at 120 last week, the current price around 77 could represent a significantly improved risk-reward proposition. That's the genuine opportunity being presented by this extreme volatility, if you can see through the fear. Silver is down another 9% from Friday's close, but from that 71 intraday low, we're already up 17% to current levels around 83. So what exactly am I watching when that New York session opens? First, does this bounce from 71 to 83 actually hold and build momentum, or does it fail completely and force us to retest those 71 lows? Second, does Bitcoin manage to stabilize in that 74 to 76,000 range, or does it break decisively lower and confirm that more risk-off selling is coming? Now we get to see whether the selling pressure is finally exhausted or if there's much more to come. Third, do equity markets manage to stabilize and find some footing, or do they gap down hard at the open and drag precious metals down with them in another wave of forced selling? Fourth, does that Shanghai premium hold at the current 22% level, or does it start to compress significantly? If it compresses toward 10% or lower, that would signal that physical demand is finally weakening. But if it holds or expands back toward those 30 to 40% levels we saw over the weekend, that signals physical demand remains incredibly strong and paper manipulation is starting to lose control. Fifth, do we get any major news about banking sector stress, government shutdown resolution, or escalating tensions with Iran? Any of these developments could move markets violently in either direction without much warning. Where does all of this leave us right now? Number one, physical and paper markets are completely disconnected from reality. Singapore and Australia have people queuing to buy even as prices crash. China and Hong Kong are sold out. JD.com is showing a 95% premium over paper. Silver remains in backwardation. SHF vaults remain stable. This is absolutely not a fundamental breakdown of precious metals demand. This is pure paper manipulation combined with forced liquidation from over-leveraged positions. While physical demand continues to increase around the world, the divergence between paper and physical pricing is actually growing larger, not smaller. At some point in the near future, one of these two markets is going to break decisively. History strongly suggests it's the paper market that breaks first, not the physical market. Number two, this New York session is going to tell us whether 71 was the actual bottom or if we're going to see significantly more selling pressure. The 17% bounce to 83 is definitely encouraging. Gold up 7% from the lows, silver up 15%. But we absolutely need New York to confirm whether this has any staying power. If this bounce holds and continues to build momentum, the worst of this sell-off could be behind us. But if it fails and we retest 71 or go even lower, there's probably more pain ahead before we find the real bottom. Watch that opening action very closely. The unresolved tension we're dealing with right now is this. Silver hit 71 and bounced 17%, but does New York confirm this is the actual bottom? Or is this just a temporary relief rally before even more downside? Physical markets around the world are screaming strength. Queues, massive premiums, backwardation, sold-out dealers everywhere. Paper markets are screaming stress, forced liquidation, margin calls, wash trading, manipulation. Which one wins when New York opens? That's what we're about to find out. Do your own due diligence and make sure you understand the risks, because this level of volatility is absolutely extreme. Leverage trading in these conditions carries exceptional danger that can wipe out accounts quickly. Think for yourselves. Use your own judgment. Don't follow anyone blindly, including me. This represents real risk to real money. While some are observing a significant divergence where paper market selling sharply contrasts with physical market tightness, it's absolutely critical to interpret this information carefully. The recent low of 71 may present a genuine entry point for some investors, but it could also simply represent a pause before we see further decline. New York is going to tell us which scenario plays out. Stay sharp out there. Watch the data closely. Invest with logic and discipline, not hype and emotion. OG signing off for now.